All right, guys, November 11th, happy Veterans Day to all those that have served. It's Monday, the 11th, November. We had a market in this holiday come in with the banks closed, with bond market closed, not a lot of activity. So we open up week on Hong Kong. One thing that wasn't necessarily catchable, take that play button to the side, but it was readable. The market opens up bearish on Hong Kong unrest, and it starts to get hit a little bit. Then all of a sudden, it jumps, and not only jumps, but slides right through this yellow line in here. Now, this yellow line I put on the open for a reason. One of the reasons is it usually works as good resistance if we open up and go below it, or good support if we open up and rally through it. In this case, we open up and get hit a little bit, and when we go to test it in here for the first time, it just runs right through it like it's not even there. When that happens and we get to be in this area right here, I begin to say and tell everybody that this is kind of a B2B transition from bearish to bullish. We opened up weak, we went down, and then all of a sudden they do this. And I'm not claiming, oh, I bought it here, it was easy, because I didn't. But I did read this halfway up this bar that, in fact, it's probably going to be hard to go back down through the lows for a while. And the first opportunity that I had seen to get long, and I did not, I missed it by not trying, was when you start to see some selling, like in here, come in, that becomes a little line in the sand of where bears might defend. So when you start to get over that, and that price was 78.25, I had said that's when you can get your next move and move through this consolidation box that you begin to see in there. And again, consolidation box always has to be figured on market comes down, goes up, comes down, goes up, rotation. And all that rotation, the bottom of it, top of it, creates this box. And you could always also assume in any congestion box, you're going to have open longs and open shorts. So through this red in here could be some upside. I put it on replay, so we'll see it go, I think, maybe a little faster than real time. But after this move and this move, it really dried up and become unopportunistic, keeping your hand off the mouse, not doing anything after this next jump to, I think, 82.83 was the next target, and that's where it went. And after that, it was really kind of a dead trade. First move after the open again was this rally, and the second one coming above this 78.25 area, just kind of the top of this box, and where this selling had come in and where they might defend it. Let's speed this up a little bit. You don't always have to catch everything that you predict, but you want to read it in real time and understand it. And so you get an idea of how it looks different in real time, how it can look different in real time than after the fact. You know, patterns are easy to see after the fact. Can you read them, develop that skill in real time? You could see now the selling becoming more clear when this red highlights. That's just quick sellers that come in aggressively. And when you start breaching above them, you start to put your horns back on to not only play it for the next move up. So this is the first move up, and this is the area. The next move up, you have a target up there at 82.83, or for whatever reason, that's kind of the next ledge or the next step that you could go. If for whatever reason you have that next move, you put yourself in a position to establish a target. Now you establish an entry, and most importantly, you establish an exit for a loser. So if this is a potential long trade, which it is, the question is, and let me pause it for a second, it's not necessarily why you got in. That's important, no doubt. Where you got in, that's important, no doubt. But where the hell are you going to get out if you're wrong? Because you're going to be wrong. All right? And some people might say below the bottom of this box. Some people might say back to the open. I'm not going to say there's a right or wrong answer necessarily. But what I am going to say is the wrong answer is not having one. You got to have an exit before your entry. You got to know where you're going to get out before you get in. especially for losers. Everybody could tell you where they're going to get out for winners. You know, my teenage son could tell you where he's going to get out for a winner. Tell me we're going to get out when you're wrong, because not if you're wrong, but when you're wrong. And so that's important. And it will create some comfort in getting into trades and taking risk, because you know what you'll do if you're wrong and you have an expectation to be wrong. When you have an expectation, then you can meet it. So often in trading, people don't have expectations, so they're all over the board. They let a very emotional business become even more emotional because they don't have an expectation for being wrong and where they're wrong and why they're wrong, and the fact that that's just a marketing expense in other business. That's just an employee expense, a travel expense. Everybody who has a profitable business has expenses. Well, in trading, your expenses are losses, not necessarily chart platforms and education. Yeah, that's an expense, but also trading losses. You're supposed to take trading losses if they fit within your strategy. If you miss a lot of your trades, then that's part of your problem. You're missing winners and catching losers. You're missing trades, period. If you're taking trades outside your strategy, that's your problem. How do you know? And a lot of people can't qualify or quantify any of that stuff because they don't review accurately. They don't go back and look to say, did I see this, whether you traded it or not? Is this a setup you want to take, a breakout after a move on the side of the market where you see a qualifier? You get yourself, and I'll pause it again, you get yourself a rally to show you that the market went from bearish down in here to bullish after it cranks through the open. You could identify your congestion box so you're not caught in it, chopped around necessarily. And you take a shot to say, if it gets above some identified selling, I'll take a shot, but I know where I'm going to be wrong before I get in. And if that's your ready, aim, fire approach and you missed it, no problem. But you recognized it, you read it, you seen it, you said it. And that's the difference between reading the real time and just looking at charts afterwards and thinking, that's easy. There's another moment through this white VWAP where you should have been really cautious if you were trying to get short, because going through this VWAP easy is bullish. Much of the reason why I went through this VWAP easy was because it was coming out of this congestion box. It was leaving the station. Think of congestion boxes as a train station. Trains come, trains go. The price is the train in this metaphor. Prices come, prices go. Comes to a station, stops, goes back the other way. You got to know if you need to jump on the train as it's moving, wait for it to stop, fade it. Am I on the tracks? Can I get run over? All that stuff. Hope this helped. And again, happy Veterans Day. And thank you for all you've done.